Picture this. You're looking at a chart, right?
Okay.
And your technical indicators are just practically screaming at you. I mean, the short-term trend is totally flat, but the long-term momentum gauges, they are flashing these blaring sell signals.
Oh, yeah, like severe technical exhaustion.
Exactly. To a purely systematic trader, it looks like an asset that is just on the verge of a total breakdown.
Right. It looks terrible on paper.
But then you look at the capital flows, and institutional money is pouring into this exact same asset by the billions.
I mean, absolute tidal waves of cash.
Yeah. Portfolio managers are just flocking to it. And some analysts are even calling it, the ultimate safe harbor in a really chaotic market.
Which is wild.
It is. So you have to ask yourself, are the algorithms catching a subtle breakdown here? Or is the smartest money in the room just walking willingly into a yield trap that's hiding in plain sight?
It's basically the absolute definition of a modern market paradox. You have quantitative algorithms demanding a sell-off, while human portfolio managers are aggressively accumulating, like every single share they can find.
Which makes this the perfect mission for today's deep dive. We are tearing into a massive stack of recent market data, technical analysis reports, and geopolitical news flow from April 2026.
Right, to demystify one of the strangest vehicles in the market right now.
Exactly. The SPDR Bloomberg 1 to 3 month T-Bill ETF. Ticker symbol BIL.
BIL.
Yeah.
And just to set the ground rules early for you listening, we're going to be having a purely analytical debate about market mechanics today.
Strictly the numbers.
Right. We're looking at data, structure, and flow. This is absolutely not financial advice.
No, definitely not. We are specifically stripping away the noise to look at the structural how and the macroeconomic why behind these numbers.
Right.
Just analyzing the data as it stands today, April 14th, 2026.
Okay, let's unpack this, because before we can understand why the algorithms are losing their minds or why institutions are moving billions, we really have to understand the anatomy of this ETF. Yeah, you have to know what's inside it.
Right, because its financials look downright bizarre compared to traditional equities.
They really do.
Let's start with the baseline. As of today, April 14th, 2026, BIL is trading at exactly $91.50.
What's fascinating here is that price point is the anchor for everything we are going to discuss today.
It kind of has to be, right? Especially when you look at the 52-week range.
Oh, the range is incredibly tight.
I mean, the absolute low over the last year was $91.26. And the peak high was $91.78.
So we're talking about a 52-week range of roughly 50 cents.
50 cents. Looking at this chart is honestly like watching a glacier race a snail.
Yeah, that's a good way to put it.
It is engineered to barely move. So if we open up the hood and look at the balance sheet, what is actually inside this ETF?
Well, it's a portfolio of exactly 17 ultra-short-term, zero-coupon U.S. Treasury bill issues.
Wait, zero coupon? Can you explain that? Because traditional bonds usually pay out a regular interest rate, right?
Right, yeah. Most people know the regular interest is the coupon. But we need to look closely at the mechanics of these zero-coupon bills.
Okay.
Because the structure of the underlying asset completely dictates the behavior of the ETF. These bills operate entirely on a discount-to-par mechanism.
Meaning you don't get a quarterly check in the mail.
Exactly. Instead, the fund buys the Treasury bill at a discount. So say they buy it for $99.
Right.
And then when it matures, the U.S. Treasury pays the full face value of $100.
Ah, I see.
Yeah, that intrinsic pull to par is what actually generates the yield for the fund.
And the timeline for that pull to par is incredibly compressed, isn't it?
Oh, very.
The average maturity of those 17 T-bills is just 0.12 years. That's what, roughly 44 days?
Yeah, just about a month and a half.
Yet this fund holds a staggering $50.27 billion in assets under management.
It's massive.
Over $50 billion is just parked in this hyper-compressed time frame. I mean, looking at that 44-day window, this isn't an investment vehicle for capital appreciation, is it?
No, not at all.
It's more like a giant financial shock absorber, like a financial mattress.
That is exactly what it is. And that 44-day average maturity, that's the structural genius of the whole operation.
How so?
Because it virtually eliminates duration risk.
Okay, unpack duration risk for us really quick.
Sure. Think about duration risk mathematically. The longer you lock up your capital, the more sensitive it is to interest rate changes.
Right, because you're stuck in that specific contract.
Exactly. So if you hold a 10-year Treasury and inflation suddenly spikes, the Federal Reserve is going to raise rates.
And then what happens to your 10-year bond?
The secondary market value of your 10-year bond just plummets
Mhm.
because nobody wants your old, low-yielding debt when they can get higher yields on new debt.
Right, that makes sense. But with an average maturity of 44 days.
The capital is never committed long enough to suffer a meaningful drawdown. It matures before the macro environment can really hurt it.
So it's kind of like the difference between signing a strict 10-year commercial lease in a super volatile real estate market versus going month to month.
That's a perfect analogy. Right.
Like if the neighborhood goes downhill, or in this case, if the macroeconomic environment shifts, you can just pack up and reset your terms next month.
Exactly. And that's why the net asset value, the NAV, sits practically cemented at $91.50.
Because the underlying bills are constantly maturing, paying out their face value, and then rolling over into new bills.
Right, rolling over at the current risk-free rate, the cash is just continuously recycled.
And since the underlying asset is U.S. government debt that matures in mere weeks, the default risk is basically zero.
It is as close to pure risk-free liquidity as the market allows.
Okay, so what is that rolling month-to-month lease paying right now?
The current yield is sitting at 4.01%.
Okay, 4%. And they just paid out a dividend of $0.264 per share on April 1st.
Right.
And I noticed the net expense ratio for the fund managers to handle all this continuous rolling of paper is a really efficient 0.14%.
It's incredibly cheap to run.
It's cheap, it's steady, it's basically a fortress. But that brings us back to the data anomaly that kicked off this whole deep dive in the first place.
Right, the weird trading volume.
Exactly. If the price is a flat line and the asset is basically a static financial waiting room, why is the trading volume suddenly exploding?
The flow metrics we're seeing in the April 14th data are honestly staggering.
Yeah, over 21.6 million shares traded in a single session.
Which is a massive deviation from its historical moving average volume.
I mean, a volume spike like that isn't retail traders moving pennies around in their brokerage accounts.
No, absolutely not.
We are looking at a one-month net flow of positive $6.74 billion.
Almost $7 billion of new money.
Rushed into this ETF in just 30 days. But the specific metric that really stands out to me is who is doing the buying. Shares of BIL held by other ETFs skyrocketed by 747% between March and April 2026.
That is a critical detail right there. You are looking at ETF of ETF packaging.
Wait, so portfolio managers aren't just buying it as a standalone trade?
No, they are aggressively stuffing it inside their own diversified funds.
Oh, wow.
Yeah, they're raising their cash allocations across the board and using BIL as the vehicle to actually hold that cash.
So they're establishing this massive cash equivalent buffer.
Exactly. When institutional managers foresee intense macroeconomic volatility, they desperately need liquidity.
You need dry powder.
Right, dry powder to deploy when asset prices eventually bottom out. But holding raw cash in an inflationary environment.
That's a fiduciary failure. You're just losing money.
Exactly. So they rotate into a vehicle like BIL. It preserves their capital to the penny, guarantees extreme liquidity, and still yields 4.01% while they wait for the storm to pass.
Which brings us back to the skeptic's dilemma here. If we understand the mechanics, that this is a super safe, zero-duration cash equivalent being just hoovered up by institutions, why are the technical algorithms screaming at us?
Right, the sell signals.
Yeah. Professional screening systems like stockinvest.us are flagging BIL as neutral/sell, or an outright sell candidate based on short-term weakness.
Yeah, it looks bad on a scanner.
But we all know how the MACD works, the moving average convergence divergence. It tracks momentum shifts.
Right.
But how does a 44-day T-bill fund even generate enough momentum to trigger a 3-month technical exhaustion signal? It doesn't make sense.
It doesn't, and that is the mechanical quirk of applying equity-based technical analysis to yield distributing cash equivalents.
Ah, okay.
The algorithms are actually reading the data flawlessly, but they completely lack structural context.
So they're doing the math right, but missing the big picture.
Exactly. Let's look at how MACD is actually calculated. It generally measures the distance between a 12-period exponential moving average and a 26-period one.
Right. It's looking for changes in price velocity.
Now, factor in that April 1st dividend payout we mentioned, the $0.264.
Okay, the moment that dividend pays out, the net asset value of the ETF drops by exactly $0.264.
Right. The capital didn't disappear.
It just transferred from the fund's balance sheet straight into the shareholder's brokerage account.
Exactly. But a purely mathematical momentum algorithm doesn't read the corporate action correctly in real time.
Oh, so it just sees the price chart drop vertically overnight?
Yes, the short-term price action suddenly falls below the longer-term moving average.
And the algorithm registers that sudden sharp drop not as a routine yield distribution.
But as a violent shift in market sentiment.
Wow. So the algorithm is essentially reading a routine rent payment as the building collapsing.
That's hilarious, but yes. The fast-moving average crosses below the slow-moving average, and the system automatically outputs a sell signal due to falling trend direction.
That is fascinating.
And if you look closely at the strict technical bounds in the data, the true underlying momentum is completely horizontal. Resistance is cemented at $91.51 to $91.54, and support is a rock-solid floor between $91.45 and $91.47.
So the algorithmic sell rating is just a complete false positive.
Triggered entirely by the mechanics of yield distribution, yeah. Not by any actual selling pressure.
Here's where it gets really interesting, though.
Okay.
We've solved the technical paradox. We know the algorithms are confused by the dividend drop, and we know that institutions are hiding billions of dollars here to avoid volatility.
Right.
But we need to look at this from the perspective of the everyday listener, the individual investor.
Always important.
Is this actually a brilliant safe haven for them, or is it a trap? I tend to view this as the retail trap.
The retail trap, yeah.
It's like finding this perfectly secure, climate-controlled waiting room during a hurricane, but you don't realize the room is pumping in a slow, invisible, toxic gas while you sit there.
That's a dark analogy, but it works perfectly. If we connect this to the bigger picture, we really have to weigh the bull case against the bear case to evaluate that trap.
Okay, let's start with the bull case. Why is that waiting room so crowded right now?
Well, the data points heavily toward geopolitical shocks.
Right.
We are analyzing sources that highlight recent severe tensions in the Middle East, specifically news flow involving Iran.
And keeping strictly to the market mechanics here, remaining completely impartial to the politics of the region, the financial reaction is just undeniable.
Absolutely undeniable.
When geopolitical headlines indicate potential conflict or oil supply disruptions, uncertainty spikes.
And institutional capital has a primary mandate during high uncertainty.
And they survive.
Right. It naturally seeks the path of least resistance and absolute lowest risk.
And BIL acts as the ultimate pause button for that capital. That is the bull case in its purest form.
Just hit pause and wait. It's exactly. If the market experiences a best-case recovery scenario, say tensions cool down, equities rally, the portfolio manager simply liquidates their BIL holdings at $91.50.
And deploys that preserved capital right back into growth assets.
Right. And if the worst-case scenario plays out and the broader market continues to spiral lower,
the manager is sitting comfortably, having completely insulated their portfolio from the drawdown.
Exactly.
But then we have to address the toxic gas in the waiting room. The bear case.
Yeah.
And to be clear for you listening, the bear case here isn't that the price of BIL is going to crash. We've already established the structural floor provided by the U.S. Treasury.
Right, the price is safe.
The bear case is the macroeconomic silent killer, stagflation.
Stagflation is the absolute nightmare scenario for cash equivalents.
Can you define that real quick?
Sure, it is the simultaneous occurrence of stagnant economic growth and persistently high inflation.
Right, so a 4.01% nominal yield looks absolutely fantastic on a spreadsheet when you're terrified of a 20% stock market correction.
You sit there thinking you are generating a solid 4% return while everyone else is just bleeding out in equities.
But let's look at the actual inflation data, which is heavily driven by the rising energy prices we're seeing in these April 2026 reports.
Right, and this is the difference between nominal yield and real yield. It is precisely why retail investors often misunderstand the true cost of safety.
So nominal yield is the 4.01% printed on the dividend sheet.
Exactly. Real yield is what that 4.01% actually affords you in the real economy after adjusting for the loss of purchasing power.
So if the inflation rate is running at, say, 5% because energy and housing costs are surging, and your safe haven ETF is paying you 4%, your real return is actually negative 1%.
Exactly. A portfolio manager running a $10 billion fund will absolutely accept a negative 1% real return.
Because for them, bleeding a tiny fraction of purchasing power is just an acceptable insurance premium.
Right. It guarantees extreme liquidity and prevents a 15% equity drawdown. They aren't trying to grow wealth in BIL, they're just parking it.
But an everyday investor often looks at a 4% yield and assumes they are building wealth.
Which is the trap.
Right. Holding a cash equivalent during a period of high inflation is functionally accepting a guaranteed, slow mathematical decay of your buying power.
You are completely safe from day-to-day market volatility, but you are slowly bleeding out from inflation.
The math is just relentless,
It really is.
which frames the ultimate debate for anyone looking at this asset. Are you willing to accept a known, calculated decay of your purchasing power in order to buy absolute immunity from downside price risk?
For the institutional managers who increased their holdings by 747% last month, the calculus is clear.
They believe the downside risk in equities far outweighs the slow bleed of inflation.
100%.
So having mapped out both sides of this, the fortress of unmatched liquidity versus the slow leaking bucket of inflation, what actually happens next?
Well, we have to look at the horizon.
Right.
The data stack provides both short-term and medium to long-term outlooks. Let's look at the immediate future, just days and weeks out from this April 14th snapshot.
Okay, so what's the short-term outlook?
In the immediate short term, the structural mechanics we discussed dictate the outcome. There is an incredibly high probability that the price remains tightly trapped in that microchannel between 91.48 and 91.52.
Because the underlying assets pull to par in just 44 days.
Right. There's literally no mechanical leverage that can force the price to deviate meaningfully from that established net asset value.
Yet the medium to long-term outlook projecting into late 2026 indicates an expected average price of roughly $91.39.
Yeah.
That is a measurable, albeit small, downward drift. If the price is supposed to be cemented to the NAV, what causes that projected tilt lower later in the year?
The single most powerful catalyst for this entire asset class,
Which is?
Federal Reserve monetary policy.
Of course.
The returns on BIL are not generated by corporate earnings or consumer demand. They are a direct, intimate mirror of the federal funds rate.
So what does this all mean? We need to explain the physical mechanism of that relationship in the secondary Treasury market for the listener.
Okay, so when the current batch of 34-day bills mature, the fund doesn't just close up shop, right?
No.
The managers take that cash, they go directly to the secondary market or Treasury auctions, and they purchase the next batch of short-term debt.
And the yield on that new batch of debt is entirely dictated by where the Federal Reserve sets short-term borrowing costs.
Exactly. So if the Fed decides that the economy is cooling too fast and pivots to an interest rate cutting cycle heading into late 2026 and 2027.
The yields on newly issued 1 to 3 month T-bills will just plummet instantly.
Yes. That forces the fund managers to replace their expiring 4% yielding paper with new, perhaps 3% or 2.5% yielding paper.
Ah. So the dividend payouts shrink in tandem with the Fed's cuts.
Precisely. The attractiveness of the fund drops, which can cause that slight downward drift in the projected price toward 91.39 as the yield premium basically evaporates.
So it's the ultimate catch-22 of the cash equivalent trade.
It really is.
You have successfully immunized your portfolio from corporate bankruptcies, earnings misses, tech sector crashes, but in exchange, you've surrendered total control of your yield to the Federal Reserve.
You are 100% at the mercy of their interest rate decisions.
Wow. Okay, to pull all of these threads together for you listening, BIL is just a fascinating structural paradox.
Truly.
It's simultaneously a masterclass in capital preservation, holding $50 billion perfectly steady through geopolitical chaos, while currently triggering algorithmically generated sell signals simply because it distributes its yield.
Yeah, mechanical confusion.
And it serves as an incredibly effective waiting room when the macroeconomic skies darken. But if inflation continues to outpace its nominal yield, that same waiting room is quietly and methodically eroding your actual purchasing power.
It demands a highly strategic approach. I mean, in a volatile inflationary environment, this cannot be treated as a set-and-forget-it allocation.
Definitely not.
The vigilant investor must constantly weigh the real yield against the nominal yield.
But I want to leave you with a lingering, slightly provocative thought to mull over on your own.
Okay.
We detailed the massive, undeniable footprint of institutional money moving into this asset, a 747% increase in ETF holdings in a single month.
A historic defensive rotation, obviously.
Right. And that implies portfolio managers are looking at the current landscape, the sticky inflation, the geopolitical tension, the equity valuations, and making a very deliberate choice.
Absolutely.
So my final question to you is this. If the smartest institutional money in the world is suddenly willing to take a guaranteed mathematical loss to inflation just to hide $50 billion in a 44-day waiting room, what exactly do they think is coming for the broader market that the rest of us aren't seeing yet?
It's a sobering thought.
It really is. Keep questioning the underlying mechanics, stay curious about the data, and we will see you on the next deep dive.